Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you if you're watching any of my videos for the first time. I use this in a little bit different context. Every week, I do a number of videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. Then after I'm done with all of that, I go back and I look at all the daily charts and I pick out the ones that maybe I didn't talk about very much or even at all. And I put them together in this video because sometimes we can get some insight as to what's happening in the market by looking at charts that aren't necessarily telling us anything that's really explicit right now. We can just get an overall feel for what's happening. And sometimes that can be helpful to us. There are also some charts that I only show in this video. These are charts that I look at every day, but they really don't have their place in any of the videos. So I stick them into this video. This is being prepared for Monday, October 16th. The first chart is one of those charts that I don't really show in any of my videos, so I include that here. This is a chart of the VIX, although the VIX here is invisible. Then on top of the VIX, I have a 50-period exponential moving average, and that's the blue line that you see. And what this is trying to measure is the range of the VIX over a period of time. The VIX typically will use static numbers, 12 to the downside and 20 to the upside. And we're currently down below 20. Well, as you can see by this chart, we don't stay in those ranges all the time. The VIX can go outside of this range and stay there for a number of years. And so using this blue line with this moving average, that allows us to be more dynamic. And we were in a higher range back from about 2008 to 2012. We slipped down into a lower range from 2013 up until the COVID crash. Then we were in a higher range. Now we could potentially be coming down to a lower range again. We don't really know that for sure. We're just keeping an eye on this, but it does look like the VIX has been coming down overall. Then we look at the VIX, and then we look at a ratio between that VIX and the 3-month average of the VIX. And what I follow is the red line. When this is going up, that means that on a ratio basis, the VIX is having a tendency to outperform its average VIX over that 3-month period, showing that fear is increasing slightly. And that's a bit of what we've been seeing as the market has been running into some problems going back into August and September and right now in October. Then sometimes the VIX doesn't really help us all that much. And so we use some different measurements. This is a VIX to S&P 500 correlation. And that's what we see in the middle part of this chart. The top part is a 5-period simple moving average of the VIX. And we look at that every day. Well, what we look for in this middle area is when this correlation really gets to a high reading, sometimes the market is going to react in some kind of a way at that time when we come and spike back down below this dashed line. Well, right now we're getting a very low reading with this correlation, so we haven't been paying attention to this chart. Then we also measure the speed of the VIX, and we do that by using an RSI based on 19 periods. We can look for extreme positive or negative readings. Now, this goes in the opposite direction of the market. When the VIX is going up, that means stocks are going down. When the VIX is going down, that means stocks are going up. Even though we're climbing with the VIX, we're not getting an extreme reading currently. We got one not too long ago, and I showed this chart in the daily video, but the last week or so, we haven't been seeing any kind of an extreme reading. Then we look at another measurement that's like the VIX. This is called the skew index, where the VIX looks at the money options. The skew index uses its out of the money options to compute whether it's going higher or lower. And you can see when we get up into this red area, spike out and start to come down, sometimes that marked a continuation, sometimes it marked the top, sometimes it marked the bottom in the market. We don't really know what this is telling us at that time, so we have to use other charts to give us some context. Then we have the MOVE index on top, which measures the volatility of bonds, the VIX, which measures the volatility of stocks. Then I have the spread. That's the green line between the two. When this is falling, that means that stocks are more volatile than bonds. And when this is going up, that means bonds are more volatile than stocks. And then I have a red line here of the S&P just to give us some context. What I also follow is the correlation down on the bottom, and they're not having a real strong tendency to go in the same direction. So we're not really getting all that much from this chart right now. Then we have a day version of the equity put call ratio. And as I always say, this is the last chart to update. So a lot of times I can't include this in the daily videos, even if I wanted to. where when we go up, that means there's more fear in the market. When we go down, that means there's less fear. Then we have a number of different fear gauges, which are kind of like the VIX. When these go up, that means there's a lot of fear. When these go down, that means fear is decreasing. And it's a little bit skewed because of the whole COVID move here. But this fear gauge has pretty much been chopping sideways and hasn't really been giving us any insight lately. Then we look at where are we from the all-time high, which was set in early January 2022. We're down 10.19% from that high. And over on the right-hand side is Friday's close. Then we do a number of advanced decline line studies. This one in the middle here is a cumulative advanced decline line of the NYSE. And this has been under some pressure lately as we've been having some difficulties in the market. Then down below, we have an advanced decline line measured in one particular way. And we try to look for support or resistance or breakouts or failures using this chart. Then we have another NYSE advanced decline line, which is calculated slightly different. And I have a trend line going up here. And as long as we were going along this trend line, things were more positive. Now that we've broken down below that trend line, we're more negative. And then we have a common stock study based on the NYSE, where we have the advanced decline line on top, and then based on volume is down below. And we look for divergences, convergences, and right now they're pretty much going in the same direction with each other and not showing any real big moves. Technical alerts are put out by stockcharts.com, and this is for the whole week that we just ended with. When it's blue or green, that's considered positive. When it's red, that's negative. We read this from the bottom up, where the first ones that came on Monday, the first signals, they're at the bottom. And then as the day unfolds, there's more and more alerts that are added here. And we can get kind of a picture of, okay, if there's a lot of red alerts, that typically means we're having a down day. If there's a lot of green or blue alerts, then that means things are more positive. Then we also look at 5 main indexes, the S&P, which is everything that I usually focus on. But then we look at other indexes as well, including the Dow, the NASDAQ 100, the mid caps and the small caps. And Stock Charts has this objective tool that takes it and looks at it on a technical analysis basis and rates that chart from 0 being the lowest to 100 being the highest. Coming in first place, which has been in first place for quite a while now, are the QQQs, which is the NASDAQ 100. They're coming in at 97.2. On the one hand, you could say, okay, the market's been under pressure lately, and you can see this line here where we're pretty much flatlining. So the market's been holding up. That could be more positive, but at the same time, the QQQs have been under pressure, but it's not necessarily being reflected in this technical score. So that's more of a negative approach for using this type of an indicator. Then coming in second place is the SPY, which is the S&P 500. It comes in at 81.7. The diamonds, which is the Dow Jones Industrial Average ETF, it actually ticked up a little bit to 62.6. And next place is the mid caps, or are the mid caps, at 28.8. They've been under a lot of pressure lately, and you can see where their technical score has really been declining. And in last place are the small caps, represented by the IWM, which is the ETF for the Russell 2000 Small Cap Index. They have a score of 15.3, and they're not doing very well these days. And that's not positive for the market. If we want the overall market to become more positive, we want the small caps to be doing better. Some short-term charts. We have a short-term rainbow, and I've been showing this on and off as we've been chopping around lately. This goes from 10 periods up to 50 periods using moving averages, and then they're all in a different color, so they look kind of cool. Well, we fell down below the rainbow, and now we're trying to work our way back up into the rainbow. But right now, we're just in the middle part, and the lines are starting to roll over. So you look at this, and it's like, okay, what's that trying to tell me? I'm not really catching all that much now. Then we have a thing called the boom indicator. Price has a tendency not to go very far away from a moving average. And I have 3 moving averages on this chart, a 20 period, a 50 period, and a 200 period. And I developed this indicator a long time ago. I just came up with the name with it for it just a few years ago when I was attending a webinar called the boom indicator. But when we get far away from the 20 period moving average, either above or below, price has a tendency to come back to that moving average. The moving average acts like a magnet. We're just about at the midpoint right now, where we had gone extreme negative when we were going lower. We're showing some improvement here. We're just a little bit below the midpoint for the 50 period moving average, and we're still above the midpoint with the 200 period moving average. So We use this like an oscillator, but it's not really telling us much right now. Some intermediate term charts. Here's a longer term rainbow going from 50 periods up to 100, where we're coming up to the underside of the rainbow. And the longer that we're staying below this, the more these other lines are starting to roll over. We want to see this go back through and go to the upside if you're more positive on the market. This may act as resistance if you're more negative on the market, and we could see a fall from here. Then we look at standard deviation. Now I have a standard deviations chart, and I use that in a bit of a different context. This is like looking at the average price over the last 10 periods, since this is based on 10 periods. And then we say, okay, is the stock or index or whatever you're measuring really moving? It's not telling us the direction of the move. It just means, is it moving at all? When we come up above the moving average, that means, yeah, we're really moving. When we drop below the moving average, that means, no, we're not moving all that much. Right now, we're pretty much on the moving average itself. Then we have a trend meter here called the Sean trend meter, and we're still in this more neutral area now, even though we have been showing a little bit of an improvement. We have the Connors RSI, which is like a regular RSI. We look for extreme positive or negative readings. We're below the midpoint here in declining, so that has more of a negative bias to it. Then the mass index, which is not generating a signal right now. It looked like we were getting a signal, but it didn't really help us out all that much near the latter part of August going into September. It's trying to come back up again. Will it generate another signal that may be helpful this time? We have the percent B indicator. Up on top, we have the Bollinger Bands. We spend a very limited amount of time going above or below the Bollinger Band. And when we do, that's what the percent B indicator measures. Right now, we're just about at the midpoint because the S&P is just about at the midpoint of the Bollinger Band. So we use this like an oscillator, but it's really not giving us any indication right now. Then we have the Ichimoku cloud. For a while, this was acting as support as we were in this green area. And really all this is a set of moving averages that are shifted forward that sometimes can act as support or resistance. What we're waiting to see now is, now that we've fallen below the green cloud, and if we do start to go back up, is this red cloud going to provide overhead resistance? The green cloud provided support for a while, and then we ended up falling down below that. Then we have some moving average studies based on exponential moving averages. We have a 20, 50, and 200. And when we're declining, that's more negative. When we're advancing, that's more positive. Well, we're going down with the 20, 50, and 200 currently. Then we compare the S&P 100 to the S&P 500 to see if there are any kind of divergences that are happening. There was one earlier in the year, but right now they don't seem to be diverging all that much. We use a point and figure chart, which we're not seeing any new X's or O's drawn for the past week. The last signal that was generated was a double bottom breakdown on the 26th of September. And since that time, we really haven't seen anything new on this chart. Some long-term charts. We take what's called an anchored moving average, which goes all the way back to the all-time high and then sends that forward. We're still well above this point. So as long as we're far away from it, I haven't been using this chart. Then we want to know, are we above or below the 200-day simple moving average? Currently, we are above it. We got kind of close there for a while, but so far we're still in green territory. Then we have a long-term rainbow going from 50 periods up to 250 periods, where we're pretty much inside of the rainbow right now. And just like the other ones, the longer we stay in here, the more the upper lines are going to begin to roll over. And then we have a weekly chart of the S&P on top, a weekly chart of the German DAX in the middle, and we look at the correlation between the two down on the bottom. And even though the correlation is getting a little bit stronger, it's still not really suggesting that the two are going in the same general direction. We have a long-term moving average study. I have a 50-period study up here on top. That's mainly for reference, and then a 150 and 200. When we're below this 250 line and declining, that's negative. Down on the bottom, when we're below the 250 line and declining, that's also negative. Whether we're going up or down shows that we're improving or not improving based on a longer-term moving averages. We look at different support and resistance levels. This is a chart that I talk about pretty much in every daily video, but I don't show it. How this chart was created was we took the June 2022 low, then the October 2022 low, and drew a trend line. Then we went up top, and from the all-time high, we drew a parallel line. When we were coming up last spring, this was offering some resistance. Well, we were able to break through that resistance and move much higher. I only mention this because even though we've been coming down, we're still above this downtrend channel upper line, and that's what I call it. And I don't show this unless we start to get close to this line again. Then we take going from the COVID low to the all-time high, and we just separate the whole price movement into 25% chunks. And these are called quadrant lines. And you might think, it doesn't really have anything to do with anything. Well, it sure did earlier in the year, back in 2023. There were times along the way here when it acted as support. When we were trying to go higher, this acted as resistance, and then we were able to break through it. If we do start to really turn and come down, we're going to be watching this level to see if this support level will hold. Then we have a long-term fib chart. And what's interesting about this, we're still above this green line and blue line. These are two separate Fibonacci levels that are on top of each other. And as long as we stay above this, that means that longer-term support is holding. And we look at some broad market measures. This is the Vixen, which measures the volatility of the NASDAQ 100. There's a lot of crazy data in the top chart, so I mainly pay attention to the line chart, and it's just showing where fear has been picking up as the market's been under pressure. We compare the Dow with the transports. When the red line is below the black line, that means the transports are underperforming. In a healthier environment, we want to see the transports doing better, and they've been underperforming lately. And we have some Fibonacci levels for the NASDAQ. We're chopping around this 50% retracement level now, and then we were able to break above that. Well, later in the week, we saw some weakness. Now we're going to wonder, are we going to come back down to this 50% retracement level? Then we have the NASDAQ 100, still above this 61.8% retracement level. If we really start to go to the downside, will this end up providing support? And we look at the financial sector, even though it's working off of a recent golden cross, we've been below its 200-day moving average for a long time. And if this continues, we're probably going to see a death cross here. Here's a longer-term look at the financial sector. We're going back to 2007, where we set a high, and then we saw the whole great financial crisis. And then it took us a long time to get back up to this level. We hit this resistance point right at the point of the COVID plunge. That's kind of interesting. But then when all of the liquidity was dumped into the market, we really made a roaring comeback, broke through this resistance level. Now this becomes support if we start to come down. And for the most part, the support level is held. We're still kind of far away from this, so I haven't been showing this chart. If we do see more weakness, I'll be showing this chart quite often. Then we have a weekly chart of the QQQs, which is the NASDAQ 100, and then an anchored moving average going back to the all-time high. We're still well above this level, so I haven't been showing this chart. Here's the bank ETF, which really took a dump back in March and been chopping sideways ever since and continues to be in a downtrend. We look at the regional banking ETF, which is really underperforming the financial sector. That's showing a lot of weakness. Then we take a ratio of the Qs to the diamonds, which is the NASDAQ 100 to the Dow, showing that they're having a pretty strong tendency to go in the same general direction when we do a correlation on the bottom. Then we look at the new highs minus the new lows for the NASDAQ and look at them on a cumulative basis. And going way back into late 2021 into 2022, we've seen that this has really been underperforming. I was pointing this out for a long time, but it's like, okay, this has gone on for so long. I'm not quite sure this is really having that big of an impact. A little bit more current indicator is on the bottom, where we just take the new highs minus the new lows. When we get a negative result or a result below zero, that's more negative. When we get a result that's positive, that is more positive for the market. Okay, I mixed up saying that part. Then we have some rate of change charts that are based on very long periods. We look at right now, and then we go back 250 trading periods ago, and we see that we still continue to show some longer-term strength. Then this is that same chart going all the way back to 1980, also showing that longer term, we're still looking rather healthy. Keeping an eye on some bond measurements that we use. The red line here is the S&P 500. The blue line is the TLT, which is the long-term bond ETF. They're having a pretty strong long-term relationship, meaning they're tending to go in the same direction. Their shorter-term relationship, based on 10 periods, it's improving, but not as strong. And then we have the spread measured a couple of different ways on the bottom. Then we look at bonds and we compare them with stocks. When this is going down, that means bonds are underperforming, and that's exactly what's been happening lately, even though we've been chopping sideways. Then we look at value to growth and take a ratio of that, and that's the black line where it's been declining. And then we compare that to the 10-year yield. We're not really getting anything useful right now because the correlation is down into this neutral area. Then we have another ratio between the Qs and the long-term bond ETF. They're having a fairly strong tendency to go in the same direction. So if the NASDAQ 100 is going up, the bonds are going up. And then the inverse of that is also true. Then we look at the 1 to 3 month T-bill, which you could call cash, and we compare it with further out bonds, 3 to 7 years. And when I first started using this chart was last spring. I did a supplemental video because it looked like we were seeing a real change in the environment. That's this red area. When this is going down, that means, oh, maybe the Fed's done raising interest rates. Well, that didn't last very long, and we ended up shifted back, and we're into this blue area now, and we keep going up and up and up and up and up, meaning that the market's not really sure what the Fed's going to do concerning interest rates. Then we look at shorter term bonds based on 1 to 3 years, and we compare them with 3 to 7 year bonds. And when this is going up, that means that the market is fearful that there's going to be rising interest rates. Now, think about the logic behind this. If you're pretty confident that rates are going to go up, would you buy shorter term maturity bonds that you can roll over into the next higher rate? Or would you buy longer term bonds that locks you in for a period of time and you might be missing out on some higher yields into the future? Yeah, you want the shorter term bonds. So when this ratio is going up, that means that there's uncertainty about interest rates. It looked like it was changing there for a while, but then we shifted and started to go back up. Then we look at TIPS, which are Treasury inflation protected securities. People get into those when they're worried about inflation. Then they get into longer term bonds when they think, okay, interest rates are done going up for right now. I can lock myself into a longer term bond and enjoy a higher yield on that bond. Well, when we compare this to 3 to 7 year bonds, the TIPS are actually underperforming. But what's interesting, when we look further out, the TIPS are outperforming. And so this means that looking more out into the future, the market is more uncertain and more worried about inflation than they are when we go back and look at these shorter term maturity bonds. Then we have an equal weight that's in blue, and we compare that with an inverted version of the MOVE index. This is a newer chart. I'm really not sure if this is giving us really any insight. Then we look at the 3-month yield going back to 2007. What I've been saying over and over is, now, we could be getting into a new interest rate environment, but what we've been watching for here is we rolled over back in 2007 at about this level, and that's when we saw the great financial crisis. So we've been waiting for the 3-month yield to roll over here and see if it really starts to come down. Is that going to lead to any kind of a crisis that we saw back in 2007 through 2009? Well, this keeps going up right now, and we might be shifting interest rate environment, so we're not really sure if this is going to be useful or not. Then we have a number of different yield curves, the 10 to the 2 and the 10 to the 3 month. Even though they're ticking back up, they're still inverted. The 30 to the 5 and the 10 to the 5 have been flirting back and forth between being inverted and then going back to looking more normal. The most important ones are the top two, and that's what the market tends to use. Then I have a number of possible positive scenarios, and I've been using a lot of those charts in the recent videos, but there's a few that I haven't. This looks at the broad market with the Amex, NASDAQ, and NYSE, takes a 5-period moving average of their highs minus their lows. When we get a result that's below 0, that's a broad measure of things being negative. When we're above 0, that's a broad measure of things being more positive. We're currently negative now, which has kind of been feeding into the market declines that we've been seeing. Then we look at the stocks that make up the S&P 500 and what are their 200-day simple moving averages doing. We can use this like an oscillator, but we haven't been extreme positive or negative for quite a while. And so we just look at the general direction where this had come down here, showing a little bit of an improvement, but it's really been chopping around and not being all that useful to us. Then we look at the 2-year Treasury yield, because sometimes when we top out and start to come down, that can often give short to intermediate term support to the S&P. Problem is, this thing keeps going up, and about the time we think it's going to roll over and come down, then it turns and goes back up again. So this chart hasn't been all that helpful either. Thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a great weekend, and I will talk to you in the next video.